No, it's okay. Yes. Fine. For some time the voice has been muted. Okay, for some time now. I just check it. It was muted. Okay. No, inshallah, no problem. Now what we have to do, we have to make sure that how the things has to be done. Okay, how we have to make sure that it has to be done. One minute. Okay, here we have not done in the income statement and profit statement of financial position. Is it right? Here we have not done in terms of what? In terms of income statement, in terms of statement of financial position. In the income statement, we have investment income. Is it right? We have investment income. Is it right? We have other comprehensive income. In the financial one, statement of financial asset, you will have the investment as such on the asset side. Is it right? On the asset side. Oh, 1 minute. Just I want make it show. Is that first year how much? First year is 1006. Second year is 1050. Third year is 1100. Is it right? Next, whereas in terms of OCI, other comprehensive income, is it other comprehensive income 1450? Is it right? 1050 and how much is that? 400. It is also minus. Whereas in the assets, how much we have to take? We have to take 11,000s. Is it right? 11,000s, 10,400, and last year it will not be. Is it? We have not. This is the how we have to make presentation in the financial statements. Right? Now, this receivables. What is the receivables? Basically, what is factoring? Factoring is nothing but, in simple terms, you see, in simple way, is it right? In the simple way of factoring, you are getting some checks. Is it right? You are getting some checks. We'll do this and we'll stop here. Okay, we'll complete this and we'll stop. We have some checks. Is it right? When you have the checks, assume you have a checks of from next year. Okay, from next year, from June to December. Is it right? June to December. You have checks of 1,000 each month. Okay, means how much is the 7 months. Okay, 7 months. How much is the 7,000 riyals you are having with you? Is that 7,000 riyals you are having? Now what you will do this, you will go to the bank and say that I am having 7,000 riyals with me. Checks are there. On these checks, I want to convert it into cash. The bank, what the bank will do? Bank will say that, just I am taking an example. They say that okay, we will charge 500 riyals. And we will give you cash of how much? 6,500 riyals to you. And whenever the check will be in cash, the check will be transferred to the bank account, not to our account. Okay? Is it right? Now that's the basic concept lies being. Is it right? This is called as in simple words, it is a factoring. Again, I will explain you this. You have the checks next period, 7,000 each month, 1,000. Total checks are 7,000. You will not keep the checks and say that I will wait till the month comes. Okay, you will immediately take the checks. You know, checks will never be bounced. If it is bounced, it's a criminal act. Okay, they will take action, legal action. What you will do? You have the 7,000 worth of checks. You will go to the bank and say that I want cash on this. Based on the credibility, bank will say that okay, fine. you have 7,000 checks. We will give you amount we will give 6,500, and we will take 5,500 as a commission. And whenever the time will come and the checks will be in cash, that amount will be credited to the bank account but not to your account. That concept is called as factoring. Is it right? Factoring of receivables is when the company transfer its receivables balances to another organization. Is it right? Another organization is factor is nothing but most of banks or finance companies for management and collection. Is it right? What the bank will do? Bank will make collection on behalf of the customer and received an advance on the value of those receivables in return. Is it? Does the same thing happen? Accounting for the factoring of receivables. Who bear the risk or slow payment? See, definitely there is a question mark. Sometimes there is no guarantee that the checks will be in cash. There will be a possibility that the checks will get dishonored also. A sale of receivables with recourse. These are all theoretical ones. Okay, that the factors can return any unpaid debts to the business, meaning that the business retains the risk of unrecovered. Means if tomorrow the customer is not going to pay, the risk is not with respect to bank. The risk is with respect to the client firm. Okay. Now, what is the repercussions in future if the company will approach the bank for the same reason? The bank will not accept. Okay, the bank, because what the bank will say? Bank will say that last time you have given the checks, out of 7 checks, 1 check has been dishonored. The credibility, the reliability of your customers is not that much with us. We are not going to. They will not entertain us. Is it right? That is what it says. If the situation is treated as a secured loan against the receivables. This is what it says. Only for receivables. Is it right? Only for receivables. We are going to do this type. Receivables are, see what happens usually. Most of the people will take loan, car or loan. Is it right? They will give you post-dated checks. When they give post-dated checks, what the companies will do? Companies will encash that post-dated checks, and they will get the cash from the bank. And at the time of collection, the bank will collect on behalf of the company from the customers. Now, if there is any mismatch is there, the liability is not with respect to the bank. Keep it in mind. The liability is with respect to the company as such. That is the concept of factoring. A sale of receivables without recourse means the factor bears the risk of the irre. Means no recourse means if it is a recourse, the risk is with respect to the firm. If it is not recourse, it means the risk is with respect to the factor. Now, what happens? The fees will differ. If there is a recourse, is it right? The fees will be less. Is it? No recourse, is it right? No recourse, what will happen? The fees will be more. Because in no recourse, why the fees is more? Tomorrow if the checks are not honored, the risk is with respect to the factor. Factor is nothing but the bank or finance company. Is it? Because they are taking additional risk, they will charge more fees as such. Is it? This is called as the concept of factor. Is it okay? Yeah? Now, a small example we will do, and we can put the things, concepts, we can make sure that concepts are clear, and subsequently we will do the applications at a later stage. Is it right? Tomorrow we'll start new one. Okay, and don't think that we will keep it incomplete. We will complete this. Okay, we will complete this. What it says: a entity has an outstanding receivables of balance from the major customer is how much? 12 million. On September 1st, 2000, the terms are as this. Finance company, see that the finance company will pay you how much? 80% of the receivables amount to the entity. The balance will be paid less the charges when the debt is collected in full. any amount of debt outstanding after 4 months will be transferred back to the entity. Means that it is what? It is no recourse. It is with recourse. Is it with recourse? Means the risk is with the entity, not with the bank. Finance company will charge 1% per month of the net amount and the entity at the beginning of each month. Finance company has not collected any of the factor receivables by the year end. Means what is the conditions of the factoring? They will charge this much, and they will see that whatever the amount has not collected will be factored receivables. Means they will keep the accounting very clearly. They are as simple as that. Is that the entity debited the cash from the company finance to the bank account and remove the receivables. That's what it says. Is that what will happen? See the things. You will have receivables. Is it right? You have receivables. When receivables are factored, is that receivables will become zero. And what will happen? Receivables will decrease. Is it right? And receivables will decrease and the cash will increase. Is that? That's what it says. Removed from the receivables and the bank account will be added. Okay, the difference, whatever the difference between receivables and the cash received, that is nothing but the administration cost. How should this arrangement be accounted in the financial statements as on this date? Is it the same way? The way it has to be understood that how we are going to make that. How much is that? 12 million. Is it right? 12 million. 12, if you to take into consideration 12 million, is it right? 12 million, yes, fine. Is it right? 12 million into 80%, it comes to how much? It comes to 9.6 million. Is it right? 9.6 million. The difference is how much? The difference is 12 minus 9.6, 2.4 million. It is nothing but administration cost. Is it right? It is nothing but administration cost. And what they are saying, they will charging how much? 1% per month. Is it right? 1% per month. Is it right? They are charging. Is it right? 1% per month. Fine. Now, is on September 1st, 2007. Just I want to know. Is it right? And September 30th September 2007. Is it right? 30th September 2007. How this arrangement is accounted? When they're saying how this arrangement is accounted, it is nothing but you have to write general entry. Is that you have to write how much? General entry. Okay, fine. Just I'm thinking how best I can put the things in order. Okay. Now I have given is it how much is the amount we are going to receive? We are going to receive amount of how much? 9,600. Is it right? 2.4 is the administration cost. Is it right? And what is the 1% of the amount we will get if you take into consideration? Will charge 1% of the net amount. Okay, 1% of the net amount. What is the net amount? If you say net amount is 9.6. Okay, net amount is 9.6 million. Is it right? Net amount is 9.6 million. Fine. Oh yes, we will divide it. Okay, we divide it. See what happens. Receivables, is that receivables? Receivables will be credited. Is it right? Loan from factor. Receivables will be credited. Fine. Fine. At the time of receiving the amount. No, we should not put like this. 1 minute. Arrangement for the financials at the year ended 31st December 2005. How much is the finance cost? Finance cost is 9.6. Is it right? 9.6. The finance cost is 9.6. Finance cost is 9.6 means in the profit and loss account. First we will take profit and loss account. Okay. First we will take profit and loss account. In the profit and loss account, debit the finance cost, debit the finance cost. 1 minute. At the beginning of each month, finance cost has not collected any of the factor receivables. Have not collected. Is it right? See that that is the reason. Finance company has not collected any of the factor receivable amount by the year end. Is it right? They have not collected any of the factor receivable amount by the year end. The entity debited the cash from finance to the bank account and removed the receivables from the account. It has prudently charged the difference of an administration cost. Wow, it's what happened, you know. They have done it, they have prudently, cautiously, they have charged the difference as an administration cost. See, here, what is there? You have to do what? We have to de-recognized, okay? We have to de-recognized. Is it right? We have to de-recognized is nothing but we have to do the reversal. We have to do the reversal for what? Reversal for receivables. Is it right? We have to do de-recognize. Means they have taken it into consideration, but ultimately it has not been successful. Finance company, see, it has been written here. Is it right? It has been written here. The substitute is like this. Is that finance company has not collected any of the factor receivables amount by the year end. Is it right? Finance company has not collected. When finance company has not collected, the finance company has to, if it is collected, it should be in receivables. Is it right? Is it right? If it is not collected, you have to make the reversal. Is it right? Keep it in mind. That is where it says. No, it's not a normal entry. Right? It's a reversible entry. When you are talking in terms of reversible entry, is it right? when you are talking in terms of a reversible entry, what will happen? See the thing. You have to refer it into a normal situation. Is it right? What will happen? Debit will be what? Debit will be receivables. Is it right? Debit will be receivables. Is it right? In the finance company. Is it right? First you have to know what will happen. It is like this. Bank. Is it right? Bank. It is the when the finance company has paid the amount to the bank. Bank to receivables. Is it right? Bank to receivables. We can say bank to receivables. We have the administration cost. Is it right? Administration cost. Bank is how much? 9.6. Is it right? Bank is how much? 9.6. And administration cost is how much? Administration cost is 2.4. Receivables is how much? 2 million. 12 million. Fine. This is what it has been happened. They have not collected the receivables. Is it right? Till the year end. If they have not collected the receivables, what you have to do? You have to de-recognize. Is it right? You have to de-recognize. You have to de-recognize. You have to make a reversal of this. If we are making a reversal of this, debit will be what? Debit will be 12 million. Okay? Debit will be 12 million. Credit will be what? Credit will be the bank which we have to, is it right? It's not collected. Is it right? Is it right? That the factor. Is it? That the factor loan. Is it right? How much is the credit? Credit is 9.6 million. We have not collected anything. Is it right? Commission also is not working. Is it right? So credit will be what? Credit will be the administration cost. See, very simple. It is de-recognition, reversal. Is it right? It is a reversal. How much is there? 2.4 million. First time you are doing this. Is it right? First time you are doing this. Means when it is a concept of when we have not received, when the factor has not received, definitely we are not carry forwarding this transaction for the next year. When we are not carry forwarding this transaction to the next year, then you have to remove this amount from the balance sheet, financial statement. When you want to remove these things from the financial statements, what is the entry? Is it right? This has to be reinstated. Is it? Reinstated in the financial statements. Means you have to make the reversal. Is it right? Now, how much is the finance cost is there? Is that fine? See, now see the thing. This is where the concept will work. You have made it a fine, but what it says, the value of charge. When we say this, they will charge. They will charge the administration cost. Is it right? See, administration cost is the income for the is the expenses for the client. Is it right? Is the client, and it has to be payable in future. Is it right? That is the condition we should be working. What will happen in that case? We are working. How much is the administration cost? Administration cost is the 4.1. The rule says that debit all expenses and losses. Is that debit all expenses in the income statement? Is that in the income statement? Is that this is what happened? This is in the statement of financial position. Is it right? This is in the statement of the income statement. What will happen? You are going to make it a administration cost. Is it right? Administration cost. How much in the administration cost? 2.4 million. Still it has not been received. Is it right? It has not been received, or you can say on one side they have not received, other side we are not paid. Is it right? If that is the time, what will happen? We have to make it as a payable. Is that we have to make it as a payable is nothing but it is going to be identified as a current liability. If we want to increase the liability, we have to make it on the credit side. Is it right? How much is there? It is 2.4 million. Is it right? It is 2. See, very simple. Is that first time you are doing say small one? Don't worry about that. I know it takes time to understand. The more we practice 1 or 2 questions on this, clarity will be there. At that time you remember this. Is it right? See, they have factored the amount, but at the end of the year they have not received the amount. Is that factor has not received the amount? When they, at the end of the year factor has not received the amount, what they have done? They have reversed this transaction. Is it right? They have reversed this transaction. When you have made the transactions, what will happen? You put in receivables as 12 because in future whenever the amount is going to be received, what will happen? They will say that yes, bank account to the receivables account. Is it right? Bank account will be debited. Debit what comes in. Now this is the amount. This is the entry which they have done at the time of making the factor in the initial stage. Okay, this is a original entry. Is it? This is the original entry. Little bit. It's not difficult, but little bit you have to focus on that. Okay. Now, when you have done this, but at the end of the year we didn't have anything that has been progressed. When it has been not progressed, what we have to do? We have reinstated. Or we have made a reversal. So you will get immediately, you will get something in your mind why administration cost is credit. Is that right? Because the reason of reversal, the administration cost is credit. Is it okay? I know, I can understand. It takes time for you to understand, but don't worry about that. When we are doing subsequently, when we do some practice questions on that, I will make it more clear for you.